What are the best investments during periods of inflation? That's going to be the topic of today's video. Okay, everyone, if you're a high net wealth individual or an expat in particular, go over to adamfire.com and see how I can help you. Now, on this video, I'm going to talk about the best investments during times of inflation. And I'll give you an example of this from 1972 until 1985, which would kind of, it was a period of high inflation, basically. It was just 1 or 2 years before the oil price spike of 1973, and then in the 80s, there was pretty high inflation as well. What we can see is that small cap stocks outperform large cap stocks. And also, in addition to that, we can see that value stocks outperform growth stocks. So companies that look undervalued, intrinsically undervalued, have done better, at least in that time period, than growth stocks, like some technology stocks and so on. In addition to that, what we can see is that gold did very well during that period. So for example, $10,000 invested in small cap value went to about $72,000 adjusted for dividend reinvestment, whereas gold went to $75,000. So it's one of the few periods in the last 100 years where gold has done better over a 13-year time period. However, we have to remember a number of things. First of all, every inflationary period is different to others. So for example, in this current inflationary period, gold has barely moved in US dollars. And going back to the last time period, it's actually the case that gold and silver got artificially inflated during the mid-1980s. So for example, adjusted for inflation, gold actually hit a record high. It's never ever got back to where it was in the mid-1980s, because there were some very specific things happening in the gold and silver market at that time. So adjusted for inflation, it was worth about $2,400 to $2,900, depending on which inflation metrics you use. And obviously now it's almost 1,900. So we shouldn't assume that just because something has happened in one inflation period, it's going to happen again. We can see certain commonalities though. For example, energy tends to do well during high inflation periods, because if you think about it, what causes inflation to go higher often is food prices, energy prices, and so on. So yes, energy stocks tend to do quite well. So even this year, even though the general stock market is down, energy is up about 30 to 40% in many countries. If you would have just bought an energy ETF, it would have been up by that amount. And the UK stock market is actually up for the year, at least when I was making this video, because of BP and Shell and so on. So energy does do well. That doesn't always have to mean oil ETFs or something like that. It could just mean investing into the stock market. However, we have to remember certain things. First of all, nobody for sure can predict how long inflation will last for. Nobody can predict what will happen in the economy and the markets for sure, especially in the short term. I was listening to a great video, and I would encourage you to do the same. It was a 1994 video with the esteemed investor Peter Lynch. And he was talking about many of the concerns of the time, and he made some very interesting points. First of all, he said completely ignore the noise, which is what I always say. But he also spoke beyond that about how if he spoke to Alan Greenspan, who was at the time the Fed chairman, and said, where will rates be in 3 months? He would have a good idea. But if you said to him, where will rates be in 20 years or even 5 years, he would have no idea. And he also mentioned a really great point. He said, if everybody could predict where interest rates and inflation would be 3 times in a row, almost everyone could be a billionaire. And you might say, that sounds ridiculous. How could that be? But if you think about something rationally here, if everyone knew in 2009, in March 2009, that interest rates would stay this low for this long, and the markets were only going to come up after the economic crisis, everybody would have bought a leveraged ETF. So rather than just buying a normal ETF or normal index fund or whatever, and seen the market absolutely skyrocket, everyone would have leveraged themselves up, with a leveraged ETF. And then just before the market crashed, they would have got out and got in and whatever. And even with a very small amount of money, if you are able to predict where interest rates and inflation will be over a 20, 30 year time horizon, then pretty much anyone could become really super rich. But as Lynch has pointed out, he's never met anyone who has been in this situation. I can say I've never met anyone or even met somebody who's met somebody who has been able to predict where interest rates and inflation will be 3 times in a row. Let's just look at the last 13 or 14 years or 15 years. In 2007, almost everybody thought oil prices were going to go to $200, $250 a barrel. Then the economic crisis happened, oil went down to 20 and 30. There's a bit of deflation, not too much, but a bit in 2009 in many countries. In 2010, commodities came up again because of the Arab Spring in Tunisia and Egypt in 2011 and a few other issues. And at that time, many people were worried about inflation. They thought commodity prices were going to go up. Silver, oil, platinum, many of these kind of base metals were going crazy. So in 2011, silver went from about 14 US dollars to about 49 very quickly, tripled, more than tripled very quickly. And at that time, most people thought, wow, all this QE is causing so much inflation, blah, blah, blah. We have to get into the emerging markets because Brazil, is linked to commodities. We have to actually get into real assets like gold and so on. And indeed, gold hit a record high in 2011, at least in nominal terms. What happened in the next 10 years? Well, inflation went down, the US dollar went up, commodities and gold had a very bad period, emerging markets had a bad period, completely the opposite to what most people expected. Likewise, last year, hardly anyone really expected that interest rates could go up this soon, and hardly anyone expected interest rates would stay this low for 12, 13 or 14 years after the financial crisis. So very few people can even predict 2 interest rates in a row, never mind 3. So what I would say is expect the unexpected. Don't assume that just because you're reading on the media, oh, this is going to happen, that's going to happen. Don't assume that something completely unexpected won't happen. Inflation could fall like a stone unexpectedly, or it could rise even more than people expect. But either way, don't try to predict the future, because if it was that easy, everyone would get in and out of assets really quickly. It makes a lot more sense just to have a diversified portfolio, be long-term. Don't try to predict these things. And also remember something that Warren Buffett said, and I think it's something that Peter Lynch alluded to in his 1994 speech, and that's this. If analyzing economic data was that important for private investors, then why aren't all economists really rich, right? If it was so easy to get an advantage from that, all you would need to do is, see the performance of economists. And hardly any economists I've ever met have actually outperformed the market, and I don't see any economists in any kind of rich list. So at the end of the day, analyzing economic data is it's fun. It's very interesting to read articles about what could happen in the future, because the human mind likes to predict the future. But it doesn't mean that we can actually outsmart the market. But with that being said, what has happened time and again during inflation is a well-diversified portfolio has done pretty well. We don't know when inflation is going to start. We don't know when it's going to end, but inflation will happen time and again, as deflation might happen in the future as well. So for example, Cathie Woods, the ARK ETF fund manager, she actually believes over a 5 or 10 year time horizon, deflation might come in because of the technology revolution. We don't know, and just as you can't predict inflation, you can't predict deflation as well. But the point is, if you're going to invest over a 20, 30, 40 year time horizon, you're not going to be able to predict what's going to happen and when, but you're going to know pretty much in the next 30 or 40 years, there's going to be inflation. There's going to be a period of deflation. There's going to be a period of high unemployment. There's going to be market crashes. There's going to be booms. There's going to be good times. A good investor just kind of looks past that and has a long-term plan. So one of his great quotes, and I'm going to leave this video with this last comment, one of his great quotes, Peter Lynch, in that 94 speech, he says, a good investor should care about their stomach, not their head. In other words, even if you don't know that much about investing, if you've got a strong stomach for market falls, you're going to do well in investing. In comparison, you could have the best mind, you could have a PhD in portfolio theory, but if you feel sick every time the market goes down, you're not going to do very well. How can I help you? In 2 ways. First of all, are you an expat, a high net wealth individual, or just somebody who lives in a part of the world where it's difficult to get access to quality investment solutions? In which case, go onto my website on adamfayed.com and find out more. If you don't fit into any of those categories, then in which case there's a range of free material on my website, on this YouTube channel, and indeed on my Quora, where I get over 200 or have received over 231 million views in the last few years. And finally, if If you want to actually read my thoughts in more detail, go onto Amazon and find my book on there.